Hi, this is Mark Jewell at the Efficiency Sales Professional Institute in San Francisco, California. Here to talk with you today about the financial analysis of energy efficiency projects, fundamentals. This is the first of a trilogy, fundamentals, intermediate, and advanced, where we talk about how to actually analyze projects so that they get approved. So I guess the first question you have to ask yourself is, what is financial analysis? Most people would probably agree that it's the accurate cost-benefit analysis of a proposed investment. Now, before you can have accuracy in this analysis, you have to actually ask yourself, where do the costs and the benefits come from? So let's first talk about the costs. How did you calculate your costs? Did you remember to use local labor and materials figures? If it were a government job, did you remember to use prevailing wage considerations? Some people call it the Davis-Bacon Wage Act stuff. How about demolition, recycling, and disposal costs? Did you remember to put those into the price? How about soft costs? Architectural, engineering, consulting fees? How about contingency? You know, I've been in this business for 20 years, and I don't think I can remember a time when a vendor put contingency in because they were worried about doing the limbo dance under the simple payback period maximum threshold that the customer is telling them about. So they don't want to increase the cost at all. But that really doesn't do any justice to the customer in the end. Now, how about rebates and incentives? Those things have a tendency to reduce costs. And on the other hand, you also have tax benefits. Now, I'm careful when I put these all in the same bullet because rebates and incentives are a before-tax issue and tax benefits are an after-tax issue. And it bothers me a little bit when someone says you're going to save $1,000 per year in energy bills, and in addition to that, you're going to get a $500 tax credit. Think about that. If you save $1,000 in energy bills, assuming that you're a business and you can write that energy off as a cost, you're really not saving that money. You're saving that money times 1 minus your marginal tax rate. And when you layer on the tax benefits, you immediately step through the looking glass and you're talking about an after-tax analysis. So just be careful. We'll talk more about this later. And then, of course, in landlord-tenant settings, you have this issue about who's actually paying for the first cost. It's well known that in most commercial leases, especially the ones modeled on the BOMA, Building Owners and Managers Association standard lease, not uncommon to have a clause in there that says that landlords can't pass through capital costs to their tenants with the exception of 3 items. Number 1, costs that are necessary for government regulation. 2, costs that are related to life safety. And 3, costs that are related to improving the energy efficiency or otherwise reducing the operating expenses for all tenants. So it's very possible that you could be in a situation where a landlord could install expense-reducing capital projects in his building, more specifically energy efficiency projects, and he could then go and move to take some of that energy savings back from the tenants, clawing that savings back in the form of additional rent. And we'll talk about that more in the intermediate and advanced modules of this course. Now let's turn our attention to the savings. Which utility tariff did you put yourself on? I mean, I would hope that you're more sophisticated than just taking the entire electric bill for the year and dividing it by the number of kilowatt hours that the building is using. In some territories that works. In the Pacific Northwest, for example, they charge you the same amount. In certain territories in the Pacific Northwest, they charge you the same amount per kilowatt hour regardless of what time of day or month or year it is. In Southern California, for example, or Northern California, where we're broadcasting this from, I mean, you could have a 20-to-1 difference between off-peak power pricing and critical peak power pricing in the middle of a demand response emergency. So you have to be really, really careful when you think about how you're going to value the savings to think about when are these savings going to occur and what cost per kilowatt hour will prevail at that particular time of day or month or year. Now, also, when are the savings going to start? And is there any interaction between the measures? If you're putting in a more efficient lighting system, one that has a lower load on the supply conductor, that's one thing. But what if you were to also layer on lighting controls that decrease the time that those lights would be illuminated by 50%? So you have to make sure that there are measure interactions taken into account. And then finally, who gets the savings? In keeping with what I said on the previous slide, it's very possible that a landlord and a tenant would have to carefully look at how the leases are written and what loads are connected to which meters and who pays for that meter and ultimately what the cost to each party will be before and after the retrofit. Okay? So let's shake the Etch-a-Sketch and draw a whole new picture for how we consider savings in general. Most people consider utility cost savings. They're bright enough to look at a utility tariff, or in certain areas of the country it's easy enough to look at an average cost per kilowatt hour, and they get the mathematics right. This is how much your utility bill is going to go down. Maybe not everybody, but most people do also have enough sense to look for free money, rebates and incentives from the utility in which the project is going to happen. All those things are in category 1, the utility cost financial benefits. Many, many, many fewer people think to go to number 2, which is the non-utility cost financial benefits. And frankly, in my experience, the non-utility cost financial benefits actually outweigh the utility cost financial benefits in more cases than not. I'll give you an example. Actually, I'll give you plenty of examples later, but just for the moment to illustrate the point. If you do something to increase the user-friendliness of your space, the comfort, the convenience of the space, it's highly likely that the advantage that you get in increased productivity of the folks sitting underneath those brand new lighting and HVAC fixtures actually will trump the value of that productivity increase, will trump the value of the energy savings that that new energy efficiency equipment produced. Moving quickly to the third bucket, non-financial benefits. These are things that are obviously things like Energy Star labels and LEED certifications. A lot of people say, well, that's a nice to have, but it's not really going to have any impact on the mathematics of my analysis. I would protest to that generality. I mean, in fact, I would cite as evidence no less than 6 studies have been done in the last half dozen years that suggest that an office building, for example, with an Energy Star label on it would actually have higher base rent, lower vacancy, and higher sales price per square foot. And if that's the case, then you see this leaky benefit, bucket 3 is leaking back into bucket 2, which is a great thing, of course. We'll talk a lot more about this throughout the financial analysis modules of this training. And of course, if you're really interested in this, I'd recommend you also check out Learning to See Cell Efficiency Effectively, where we hit this concept really hard. Okay, so before we go much further, realize that this module, fundamentals, and the intermediate and advanced modules are all about how to do financial analysis appropriately, informed by business acumen and a knowledge of how the costs and the benefits are going to affect the implementer. Before I even get into that, though, I want to just make one thing perfectly clear. Most decisions, at least in my experience, most decisions of this ilk are made emotionally, and then they're justified financially. So if you don't have a customer motivated to move forward in a retrofit, don't think that a fancy spreadsheet is going to do the trick, okay? It's much better to understand what motivates that customer. It's much better to reframe efficiency in a way that its benefits can be measured with yardsticks that the customer is already using to measure his or her success. Get that customer resonating at those values. Get that customer motivated. And then you can give him or her a financial analysis that allows him or her to justify this investment to capital budgeting, okay? So with that in mind, what is the ideal financial summary? Many of you may be surprised when you hear me say it's a single page. The other day I was talking to someone in the lighting business, and she was lamenting the fact that she was trying to do a lighting retrofit in a large hotel that was owned by an offshore investor. And I asked her, well, what did you send them? And she told me that she sent them an Excel spreadsheet that was so wide, so many columns. The last column was labeled AC, okay? It's impossible to print one of those things unless you have an HP large format printer for design drawings. I mean, and no one's going to print it. When a person's going to look at that thing, and by the way, the workbook had multiple sheets in it. Just one of the sheets had columns out to AC. Not surprisingly, nothing happened. The minute she decided to get sensible, condense all that financial analysis into a single page financial analysis, which I'll show you an example of later, all of a sudden things started moving. The ice flow melted, things started traveling down the channel, and within a couple of months, she had the project approved. So that is just one of just a dozen examples I could give you if we had more time of how when people think, forget this complicated Excel workbook, and think about compelling, transparent analysis on a single page, things start happening. So what does transparent and compelling mean? Well, does it show all the inflows and outflows? You can be sure that a C-level executive is going to want to see when he's going to have to put money into the project and when the money's coming out. Does it use a reasonable discount rate? Now, at this point in your education in this module, you probably don't know what discount rate is. But if I said hurdle rate or minimum acceptable rate of return, that might ring a bell. We'll talk a lot more about discount rate in a moment. Does it use a credible inflation rate? You know, in my experience, I've seen a lot of people try to goose the perceived financial returns of a project by exaggerating the level of inflation that the investor is going to see over the lifetime of the investment. And ironically, unless you think that energy is going to outpace the rate of general purpose inflation, whatever higher inflation rate you put in, you're going to have to sanitize back out of the analysis by increasing the discount rate in the analysis. So on a net present value basis, which will mean a lot more to you when we get to the section on net present value, you're actually going to have no different value at the end than if you had used a much more conservative, much less provocative value for inflation. And we'll talk a lot more about that later. Did you use the proper financial metrics? What do I mean by that? Well, it turns out that there are 3 proper metrics and there are 3 popular metrics. And as you can guess by the way I'm making this distinction, you're probably not going to want to be using popular metrics. You'd much rather use proper metrics, okay? We'll get to that in a moment. And then finally, is it a one-page financial summary? Is it something that a decision maker can look at and say, I get it. This is where the money goes out. This is where the money comes in. These are the returns I care about. They match our expectations. Let's approve this project. Okay? This is an example of a one-page financial analysis. You can see at the top in the upper left-hand corner, very clearly stated are your assumptions for discount rate, finance rate, reinvestment rate, inflation rate. You can see the time periods very clearly called out. Date 0, which is today, dates 1 through 10, which is the end of years 1 through 10, respectively. The first cost, negative numbers. Okay? The rebate received, positive number. The net first cost out, negative number. Energy savings and maintenance savings inflated over a number of 10 years. Okay? And then you have present value discounting. You have the SIR calculations, savings to investment ratio calculations. Bottom line is in the lower left-hand corner of the screen, you'll see the mother's milk of investors in expense-reducing capital projects. What is the payback period? What's the return on investment? What's the internal rate of return? They happen to be popular, but not very useful metrics. And then more appropriately, you'll see the ones that we emphasize, which are net present value, modified internal rate of return, and savings to investment ratio. And of course, the point of this module is just to get you familiar with some of this layout. The purpose of the intermediate module is to explain each one of those metrics in great detail. And of course, the purpose of the advanced module is to apply these metrics to real projects so that you can see these things in action. You'll notice, by the way, just as a sneak preview, that these metrics change over a number of years, except for simple payback period and return on investment, which are constant regardless of how long you run the analysis because they're only looking at the first year returns. More on that later.